Hey, what's going on, everybody? This is Yusef Scott, and I thank you so much for being here with me today. I want to bring another opportunity to you, show you guys how this trade is set up, and just how I've been able to profit on this particular trade. If you notice, this trade is on the Euro NZD pair. This is a pair that's not really talked about heavily, but it's one of those sort of exotic pairs that I just love. I don't trade as heavily as I do the GBP NZD. I know that trade like the back of my hand. This one I am familiar with, but not as familiar with the GBP NZD. Nonetheless, I got in on this trade earlier this month. That's when I got in on this trade, and the market had actually went against me quite significantly. All right, it went against me, but I wanted to show you guys what having strength in the market can do for you, and how making sure that you're trading at a good volume can allow you to weather the storm when the market does go against you. All right, now this particular trade here, as you see, I actually got in on this trade on, I think, May, like the first week in May. I know that because my sister's birthday is the first week of May. I got in on this trade. The market went against me, but then it quickly went up. I got in here. The market, I got in one of these. I got in on one of these, but the market, well, probably here, thinking it was going to go down, but it went up. Went up against me a couple days, and it was pretty ugly. But however, because I knew where the market was going, I allowed the trade to do what it do so that I could show you guys. Because from time to time I get people, they ask me, well, Mr. Scott, I never see that you lose. And see, the thing about knowing what to do in the market is that each one of your trades might not be in the right direction, but however, if you have enough equity in your account and you know the probable areas that the market would turn around at, you can kind of gauge if you can hold out on that trade. All right, I'm gonna give you guys another little tip as well. Make sure you guys gotta have a couple different accounts. If you only have, let's say $500, maybe put $250 in one, $250 in the other, or split it up 100 apiece. All right, you want to definitely make sure your money is spread around, because you don't want to get into a trade and then your money is you're locked in because you have a trade that has gone against you, and then if you choose not to hedge, now you're really looking bad. For those of you that know about hedging, if you put in a trade, the market goes against you, you put in another trade in the right direction, then you notice your marginal percentage would actually increase. All right, it sort of levels out. So when the market is going against you, your marginal percentage or your strength in the market will decrease. Opening up a trade in the actual direction that the market is going in will make it increase, all right, or balance out. So if you have one trade open for $1, the market goes against you, you'll notice your marginal percentage will decrease. You open up another trade going up. If your first one was going down, you open up the second one going up at the same dollar, you'll notice it'll balance itself out. Your account will be balanced out, locked in negative equity wise, and then your marginal percentage will actually increase. All right, now the closer you get to break even, the more it'll actually rise. So if you were to if you were to exhaust the negative equity that's between your two trades, you'll realize that at that point your marginal percentage will actually go back to where it originally was. All right, so with that, I was able to withstand the market going up 2 days against me, really one day, because the first day I figured it was going to range, but then the next day it went up further. Then the next day it was just very volatile, and it closed out. Great signal right here. That's a great signal. Nice pin bar. The market shot down. All right, so I was really loving the fact that the market, in fact, I was going to get out on one of the trades, one of the candles, a couple days after the market shot down. But then I decided, you know what, more than likely it's going to continue to go down. Looking at the pattern, the market is constantly making ups and downs. I figured that it will eventually go down without going up, because we have resistance at that level. All right, and definitely going back further. You know, I can put a line here, and you'll notice that we have resistance at that level and pushing back. As you see, this is 2013. That's as far as I need to go for me to see that, of the most recent price action. I know that is a pretty good level, and the market will turn around. So, and it did exactly what I thought, bringing me into the profit. As you guys see, this candle here actually dropped down 100, almost 200 pips. All right, so that being said, right now I am like $4,700 in the money, which is pretty good. Even the swap is looking great. I'm just about $100 in the swap, so that's a good thing. Just wanted to show you guys what you could look forward to. All these types of strategies, every trade you open up will not always go in the direction that you want to go in. There's times where you might think the market is going up, you put a trade in, you put a buy in, and then you realize the next hour the market goes down, or you realize not long after the market goes down. Now, just because that one hour or a short period of time that you see the market going down doesn't mean it's not going to turn around and continue going up much farther than where it turned around at or turn around from. That's just the way the market is. It goes up and it goes down. So that being said, you just have to find your place in the market where to get in. The best place to get in for a run down is at the top. The best place to get in for the run up is at the bottom. So if you can execute your entry with precision, it's no reason why you couldn't win. But at the same time, if you realize that you made a mistake and you got in too early, or maybe let's say you got in too early and the market goes against you, do you have enough equity in your account to withstand the market going against you? A couple hundred pips. So that's what if someone is over trading, if someone is over leveraging their account, there's no way you can allow the market will go against you and you'll be pulling your hair out. You'll be pulling your hair, you pull your shirt off, you'll be going crazy. So one thing I'm going to leave you with is this: as you increase your account, increase your volume. You can do that. I'm not telling you what to do, but you can do that. That way you're compounding your money. Instead of going out and trading very heavy and looking at losing all of your money if the market goes against you, it's better for me to be able to withstand the market going against me a couple hundred pips, opposed to me trading real heavy trying to make 5 pips to make thousands of dollars. To me, that's just high risk, and I'm not going to do that. So I make sure that with great calculation of what's in my account versus the volume I'm trading at, where the market might go, where I'm expecting it to go, I look at all that, and that'll determine how far the market can go before I say, you know what, enough's enough, or when do I need to balance my account out so that I can withstand the market going against me, or really just hedging. When do I need to hedge that account? So that's what you guys need to realize. It's a lot more to it than just you have to have a strategy to win, and then also a strategy for if the market goes against you. If you only have a strategy to win, and if your strategy to win isn't as accurate as you would like to believe, then what happens if the market goes against you? It's not a good day. So, and it really all starts with the size account you have and also the volume that you're trading at. That'll determine everything. Another tip that I'm going to give you guys is if you're trading, what I like to do is at the minimum have at least a 1,000 pip range before stop out. All right, or before getting red line, meaning before my account is blown. All right. Now, for instance, if you're trading with $1,000, this is just an example. If you're trading with $1,000, this example is, okay, make sure that you're trading at no more than $1. That way, if you get in here, the chances of the market going up, 1,000 pips before it actually come back down could be slim. Not saying that it can't happen, but at least you have enough time. You know, if you went on vacation for 3 days, yes, the market in some pairs it can move up 1,000 pips in 2 days, but basically you have enough time before the market. You have enough time before you get stopped out. Before you can close out that trade long before stop out. All right. So, but if you're trading at, you have $1,000 in your account and you're trading at $20 a pip, you do the math. You don't have very far before the market will actually shut you down. So you have to really think about what you're doing. Of course, I see people just trading very heavy, and that's something that we've all done before. Because of greed, or just because of impatience. You have to let your money just grow, and as your money grow, you increase your volume. That way you're stacking your money, you're compounding your money every time you trade. All right, so make your trade your best trade, and you'll always be able to stack your money. All right, so that's all I want to leave you guys with for today. Just a few tips, just to show you this trade here. That's it. I don't want to go too long because I have a lot of things to do before our launch time. So you guys, I look forward to revealing everything to you guys upon launching in just under 7 hours. All right, we have 6.5 hours before launch time, so let's get ready. All right, until next time, you guys, peace.